everyone. Wanted to thank everyone for taking the time to participate on today's Washington National Tax Roundtable Year in Review Summit. We've got an incredible lineup of esteemed panelists that are going to be sharing their insights today, going through the state of the profession with the great resignation, the great consolidation, PE investments into so many of the top 100 firms, and how more and more accounting firms are exploring collaboration agreements in the marketplace with PEOs and specialty tax providers, along with global centers of excellence for staffing augmentation services. I'd like to introduce our first panelist, the highly renowned Alan Colton of Colton Consulting Group. Alan, thank you so much for taking the time to be on today's broadcast.
Peter, thanks for having me. You know, I wouldn't miss it for the world. Is that my green light to get going?
Absolutely. The floor is yours.
Fabulous. And you know what I'll do is I'll use that old stopwatch because sometimes I get a little carried away and overstay my visit. And sometimes I think I have a lot to talk about and I look and it's 2 minutes later and I've got nothing else to fill for the next 18 minutes. So let's give it a try. So for some of you that have been on these wonderful calls before, you may hear some things you've heard before, but there's so much happening in our profession today that hopefully you'll be hearing something new. And I thought about not starting with FTX because it's a little bit of a downer, but it is real and it is playing out in front of us. And it's interesting what has gone on. I will tell you part of what I'll talk about in the next 18 minutes is private equity. And all of a sudden, private equity, who I've been talking to for a couple of years, is calling and asking the question, we thought accounting firms were this safe, insulated, low liability investment. What has gone on? And, you know, you just try to explain to them, it is all those things. This is sort of a newer industry. I'm not sure anybody has a handle on it, but if you think there's a lot of landmines out there and we in the profession, you know, are entering into them, you're wrong. And I think I needed just to have a little bit of a sort of a history course with these PE groups. You know, if you think about it, from 1880 to 2000, if I said to you, what was the big blowout of an accounting firm, you would probably answer 1987, 88, 89, Leventhal and Horwath, a top 10 firm. Probably didn't grew faster than they could keep up with the quality of the audits, and made some bad client acceptance decisions, and you blink and it's gone. I'm not sure there was much more, although I'm sure I'll get a couple of emails or texts after saying you didn't mention this one. If you go to 2000 to 2022, I would say maybe with the exception of Arthur Andersen, we were just like darn near perfect. And we've beaten that one to death, and Sarbanes-Oxley and the regulators and the PCAOB. We've got checks on checks on checks. And I would offer up that I think this is a really safe profession, and we are in a great place. All that being said, I think the regulators today are sort of beginning to pine in on what they believe is a moving target. Those of you that have listened before or read the news clips know that the big four, I'm not going to say all of them because I'll get some fan mail and it won't be good, but I'll just say most of them, you can do the math, are currently in some form of transformative discussion. If I was reading the tea leaves, I would say by the end of next year, let's call it, let's pretend we're having a call on this day 1 year from today, I don't think we'll recognize them. I think audit will go right. I think tax and consulting will go left. And they will probably go the way of private equity or some type of IPO. It makes sense for all the reasons we've talked about before. And as I've mentioned before, more than half, I believe, of the top 20 or so accounting firms will go the way of private equity. I would have made a bold prediction and probably said by the end of the first quarter of this year, I think with some type of looming recession sitting in there, it's probably going to look more into the second, third, and fourth quarters. But the times they are changing, let's make no mistake about it. I think a big thing that happened last week or two weeks ago now, and it wasn't a top 100 firm, which is really interesting if you think about it. Smith and Howard, an Atlanta-based firm, uh, 40 some million of revenue, obviously not large enough to be at 50 million, which is the cutoff for the top 100, entered into a PE deal with Broad Sky Partners, a great PE firm in New York. And with it, I think a lot of things transpired. I think other non top 100 firms with revenues of 20 million to 50 million said, whoa, I thought you had to be a couple hundred million to go the way of PE. Could we be a foundation firm as well? And as that discussion was going on, many firms and with revenues of 20 million to 200 million began to ask the question, could we, should we, or do we qualify to be that kind of foundation firm? We've had some mergers that have gotten to a finish line. Probably the biggest one would have been Friedman at 180 million, merging with Markham at 820 million. Friedman is sort of typical of the new breed of firms that is combining with equal or larger size firms today. Whether you read Accounting Today or Inside Public Accounting or CPA Practice Advisor, or if I'm leaving someone out, I apologize. Any of the rankings, they're always in the best of the best. And we have a new type of firm merging up. It's not the one that had the succession problems of the past 10, 20, 30 years. It's the firm that's hitting it out of the park. And they're making a decision that together we can accomplish something that I don't think we can accomplish separately. And it has been a merger frenzy. In our little world, the number of deals we typically do has more than doubled already, and we're not even at the end of the year. We probably should talk a little bit about this pending recession because, boy, it's top of mind. It's top of mind with accounting firms. It's top of mind clearly with the PE firms. It's been interesting watching them. About a third of them have said, I'm out. The capital markets are closed. And I said, what does that mean? They said the cost of debt has more than doubled. And that's not a good time to be in. A second third of that group has said, you know what, we're still in, but we can't give the same deal terms. We can't fund that much cash up front. The debt burden will kill us, but we'll do the same enterprise value. We just have to rework the deal a little bit. And then interestingly, and it just tells you about risk profile in any business, how people see the world differently. There's a third group of PE firms that said, you know what, we're in and we're not changing the deal. So yes, debt has gone up, the cost of it, but you know what, we're in this for the long haul, 5 to 10 years. We're bullish on your firm and we're going to run with it. So I still believe that this is, I don't know, people say to me, shouldn't we be worried about the recession? And I go, didn't we have one in 2020? I mean, I think we really did. I mean, there was a time where things were closed, but I look at how so many firms thrived. I think we underestimate that in the accounting profession, depending on your firm, somewhere between 60 and 95% of what you do is compliance work, recurring work, annuity work. The clients need to have it, whether they want to have it or not. There's a lending issue, there's a regulatory, there's a third party. And what we learned in 2020 is in good and bad times, you need an accountant, you need an accounting firm. People always ask me, how did you get into accounting? I say, it's really easy. It was 1980. And my parents realized as I was in college, I for sure wasn't smart enough to be a doctor. And I wasn't shrewd enough to be a lawyer. And what was their wisdom? For many of you, I'm sure got the same. Be an accountant. You'll always have a job. And it's amazing. It's 42 years later, and they actually knew what they were talking about. So I won't make a bold statement we're recession proof. But I do look and say, you know what? The job market is healthy. Wages are growing. Americans are spending. The GDP is strong. Business is also good. And if you look on the bigger stage, companies are largely beating their revenue expectations and reporting positive earnings results. So I won't go as far as to say that 2023 is going to be a clear ride, but I don't think it's going to be as bad as many of us maybe have felt. So I talked about the mergers that have happened. There's also some mergers that didn't happen. And I don't think we should be ashamed to talk about them. As a matter of fact, I think it's great. I think it's great to explore. It was announced a number of months ago that two unbelievable firms, best in class, Whitley Penn and Elliott Davis, were going to combine. Now, I'm not sure that the SEC and the ACC will ever combine forces, but in this case, Texas and South Carolina made a lot of sense. But you know what? They got in, they figured it out. It's all about culture and strategy. It's not about economics. And they came to realize that, you know what? We thought it made sense. We're going to go ahead and try it, and it doesn't make sense. And they took the high road, and rather than try to arm wrestle and move and make things work, they said we're both better off by ourselves, independent. And I don't know, you hear people sort of whisper and say this and that. And what happened? What happened is some really smart people tried something and they concluded it didn't work. And you know what's crazy in the real business world? That goes on every day of the week. But in the accounting firm, we still have this like stigma. If something doesn't work, it must be a failure. I'd say let it go. Let it go. So we've talked about the big four. We've talked about private equity. And now the new thing with private equity is they're coming into the middleweights. Used to be they only targeted the heavyweights. Now it's the middleweights. The question I'm getting interestingly on this whole PE universe is if all these big PE firms are coming in 5 to 7 years, who are they going to sell it to? And what I would offer up is I think it's a buyer. We don't even know who they are at this time. Could it be a bigger PE fund? Yes. Could it be an IPO? Absolutely. But as I think tax and consulting sort of move a little bit further apart from audit, doesn't mean they're not one family, but as they regulatorily move further apart, I can see buyers being some of the brands of companies that today are enormous and growing, but we would never consider them as an accounting firm buyer, whether we call it Microsoft, whether we call it Amazon, whether it's Elon Musk, whoever it might be, those are the options that sit out there today. Offshoring, right shoring, as I like to call it, we have to talk about talent. Uh, the problem hasn't gone away. It's a simple supply and demand issue, right? There's just not enough supply, and there's no economic indicators to say that's going to turn around. And when I say this, the stuff that comes back is we never should have done the 5-year curriculum. I'm like, really? Is that the best you got? I mean, that was like 30 years ago. I don't think that's it. I think the problem, and if I had a mirror, I would take it out and I would tell all of you leaders of accounting firms to look in the mirror. We're milking a dated model with a undated generation. And what I mean by that today is the kids in their 20s and 30s and early 40s, they dream, they aspire. We tell them, hey, come work at our firms and just stay out of trouble for 10 to 15 years and you too can become a partner. And if you stay long enough, like for 40 years of your life, who does that anymore? Stays for 40 years of your life, you too can become a partner and we'll slowly pay you 2 times your wages over 10 years as ordinary income if you and we are still alive by age 75. The kids today, loyalty, and we've talked about this on earlier calls, they want an experience. They want to be part of something. They want to be part of a cause. And you know what? They want a piece of the rock. And in the way we've structured these things, it's a long, slow journey to get to that. As I was meeting with one of the new PE firms recently, Cherry Becker, really sharp young kid, young by my standards, I don't know, late 30s, maybe his early 40s. And he says, you know what's great about this, Mr. Colton? He said, it was really the young partners selling the old partners on why we should do private equity. We looked in the lens down the future and said the fourth industrial revolution is here for our profession. We're going to have to spend a ton of capital to go from a compliance shop to leading with consulting and advisory and outsourcing type services. And to do that, we're going to need a capital partner. And if we don't do that, we're going to have to put our head back in the sand and just keep grinding until we can't. It's a dated model. And you know what? Talk about change in our profession. And I've said this before, change only happens in our profession when the change itself is deemed to be better than the status quo. And right now, the status quo is pretty good. So as the young kids tell me they can get a bite of the apple today, put $1 million in the bank, in 3-4 years get a second bite of the apple, and then have this thing called rollover equity, and 2, 3, 4, 5 exit into the future. Yeah, a lot of excitement. The paradigm in the late 90s when non-CPA owned companies like H&R Block and American Express came in was it's great for the old group, not so good for the young group. The exception to that we've talked about was obviously CBIZ. I think it's a new generation today, and I think we're still milking it the old way. What's a great example? You know, I get stuck in this gang crossfire sometimes at these partner and board retreats. You know, someone gets up in front of the room and says, "Hey, you know what? In 3-4 years, we're going to have a major liability." And we say, "What's that?" They said, "It's all the kids that are in their bedrooms that were never going to be properly trained. We think we're training them, we're not. And in 3-4 years, we're going to have a major problem. It's going to be called a generation gap of kids that never learned how to do it." And then you have somebody vehemently raise their hand on the other side and said, "Get a life." No, it's not the problem. The problem is changing how we train them. And the problem is figuring out a different way to get the work done. And I think that's why there's been such an incredible spike in offshoring, in partnering with a company that can produce a workforce probably not in our country at 1/3, 1/4, 1/5 the wage. And then somebody raises their hand and said, "You know what? We tried that 20 years ago. We sent 11040s to India and it didn't work." And what do I say? I say, "Really? Is that the best you got?" Like, it's a whole new world today. Why does each of the big four firms have over 50,000 people there? Why are some of the top 20 firms talking about in the next 3, 4, 5 years, 20% of the work will be done offshore? Hey, did the economics work? Yes. But here's the deepest issue, and I'll wrap up. The deepest issue is the kids today. If you want to keep stars, they're not going to do that stuff anymore. I was young and dumb when I entered this profession. The work was mundane. If I had a cell phone back there, when I talk about leaving my phone in the charger, I could have left my brain in the charger. You give that to high performing, talented kids that are on a mission to grow and be successful. What did one of them say to me a couple months ago? "Mr. Colton, by the time I did my 15th tax return, I knew how to do one. If you think I'm going to sit here and do 1,500 of them, you're out of your mind." Peter, with that, I'll call it a day. Thank you for having me and everybody on the team, Infinity Globus. Love you all.
Simply outstanding, Alan. Thank you so very kindly.
Thank
Your
you.
insight is always tremendous and greatly appreciated.
Thank you.
Our next panelist, Phil, is going to discuss the power of partnering with a PEO, and Phil is with Paychex. Phil, maybe give a little background about yourself and the company. I think a lot of folks, when they think of PEO, they only think payroll administration, not realizing it'll be a great provider for HR solutions, federal credits and incentives, business insurance, and so much more.
Yeah, thank you, Peter. I appreciate that. I'm not sure if I can top Alan's conversation there. Alan, I may need to loop you into one of my team meetings so you can talk to my generational team, and we can see what we can do to motivate them. But thank you. Thank you very much, Peter. I really appreciate it. Just a little bit about me. My name is Phil D. Kroger. I'm one of the CPA-centric managers over here at Paychex for the New York City area. I cover New York City and Long Island, and my role is to support accounting firms. Right. So I'm sure for anybody on this call that's probably had a Paychex rep walk through their doors over the past 90 days, they're probably, if you haven't seen them yet, they're probably going to be walking in with some master tax guides. Right. So number one, make sure you do get your master tax guide from Paychex if you have not gotten one yet. but also get to know your rep, right? There's a lot happening in the market right now, as Alan spoke about, and we can support a lot of your clients as well as support your firm in a lot of different ways. As Peter mentioned, yeah, we've been doing payroll for over 50 years. It's in our name, Paychecks. You might be seeing a lot of advertisements happening on TV right now, but we're so much more than that right now. We're not really a payroll company anymore. We're more of an HR company. And that's really where the growth process is when it comes to not only your firms, but also extending, what kind of consultation are you giving towards your clients? And kind of what I really wanted to talk about today as I share my screen. And Peter, just let me know if my screen is coming in okay.
It's perfect.
All right,
can see it.
beautiful.
Thank you, Phil.
So a lot of firms, when they got towards the pandemic, right, they had to reevaluate and readjust a lot of what they're doing for their services and trying to determine what's a profitable service that's in my firm, and then what's a more mundane service that maybe I'm putting a lot more effort to than I might not just be getting the bang for my buck for right now. Maybe I do need to offshore. Maybe I do need to outsource this type of solution, right? And when it comes down to it, you have to figure out what's meaningful for you, what's a big revenue driver for your firm. And there could be a lot of different processes, payroll being one of them. Maybe you facilitate a lot with benefits. Maybe you don't, maybe you also outsource that as well. But why in general the CPA industry is outsourcing traditional and tax and accounting services. And as Peter knows, I subscribe to Accounting Today. And by the way, Peter, I should give you the recognition here. Congratulations on your nomination for the top 100 accountants. It's an excellent nomination to have. And so through my research, throughout the past couple of years and going through the pandemic, there's just been a lot of chatter about what services to absorb, and then versus, what services to really start to, offshore or really just kind of refer out. And really the point of this article, and I'll get into the title of the article in a second, is that there are some firms that are choosing to stick to the traditional route, and then there are other firms that are focusing on more higher value and higher margin advisory services. And you're really starting to see more firms get into that CAS-based model, because that's really where the moneymaker is at. Your clients want to talk to you more and more. Why? Because money is always top of mind. Making right decisions is top of mind. Is this a risky move? Is always top of mind. And you guys are the trusted advisors for your clients. At the end of the day, they're going to look to you. And so maybe going towards more of that CAS-based model is going to be the way to go. So what are clients and prospective clients looking for, right? And this is kind of what they call, quote unquote, the big shift. Again, Thomson Reuters did an excellent job with this article, and I picked apart bits and pieces of it that I felt like were going to be really relatable to you guys. So one of the things that a lot of, not only your current clients, but your future clients as well, what they're looking for, right? They're looking to optimize workforce growth, right? There's very much a talent demand right now, and they need to make sure that they have every resource at their disposal to bring in that right talent. Require additional services and/or staffing. A need and want expertise in improving technology and process best practices, right? Technology, I think, was probably one of the biggest shifts as well. When it came to the pandemic, you saw a lot more clients using DocuSign. Maybe your firm started using something similar to DocuSign. Obviously, we're on Zoom now. I'm not sure how many accounting firms were using Zoom or WebEx or any type of platform prior to the pandemic. So again, just kind of the sign of the times of how technology can really give us a bigger outreach of where we're at today. Seeking visibility through metrics and benchmarks. Again, you guys are all about data. You look at reports all the time, right? And maybe not just from your transactional services, what you do now, but thinking about, hey, P&L over time and types of growth strategies, and taking a look at those metrics to see, hey, where do we see the trends? Where do you think that we can go? Needing auditing and insurance work. And then finally, businesses are facing change from new markets to mergers and acquisitions. And obviously, that's one of Alan's expertise here when it comes to M&A. You're seeing more and more accounting firms get into M&A, then you're seeing a lot more Fortune 500 companies really starting to go into more M&A right now, because that's really where the appetite's at right now. So, but don't just hear it from me. Hear it from a lot of your peers within the industry right now, right? So whether it's Julio Gonzalez, Sarah Dobeck, or even Todd Shapiro, right? And again, I won't read these word for word because I don't want to bore you, but really the point is that we're at a cornerstone right now where the accounting cultural shift is really making that big change. And it's a great time to really kind of reevaluate those services to figure out, hey, what's going to help my firm grow? What's going to give me the highest margin? What's going to give me the best growth for my firm? And what's going to also give me the most retention so that my clients are being serviced and that they're also making money, right? And that means what services should I potentially offshore? And so what I kind of want to review with you is a case study. So Paychex did a case study on a specific accounting firm that we did an acquisition with for their specific payroll and HR business, right? And so they were this particular accounting firm was a TPA in a lot of different facets, including payroll. They did a couple other functionalities when it came to HR. So I believe they were in a little bit of retirement as well as health and benefits, right? So we evaluated their whole business, right? And we were able to really, step one, when it comes to an acquisition process, we want to know all the details, right? When it comes to, hey, what is your goal? Like, where is your goal in terms of profits? Where do you want to be at in terms of more efficiency for your firm? And so when we answered all those questions, right, we were able to take into account, okay, well, how many clients are you really dealing with on a day-to-day basis? And really, more importantly, if you did not have to deal with that mundane, tedious, day-to-day, week-to-week activity when it comes to a functionality like payroll or even health and benefits or retirement, third-party administration, where else can you focus those efforts where you can get higher margins, right? So taking a look at what they were bringing in, they were yielding about $257,000 in annual revenue, but they were only profiting about $34,500 when it was all said and done. So really, once we got to that point, we brought this to our finance team. And we essentially, again, this just kind of goes through a little bit more of the story. The fact is that Stinson decided to, okay, we're gonna jump ship. We're gonna take a chance at Paychex to be an extension of our firm to really figure out how we can invest more into our clients, but not just the day-to-day services. So this is really what the outcome was, right? So out of the we were able to convert 249 clients out of the 252, and we were able to do it within 27 days and get them live onto our Paychex platform with a payout to the firm of over $400,000. So I'm gonna ask a rhetorical question here because I know majority of the people are on mute. If you had a client base that you were doing payrolls for almost 250 clients and you had an opportunity to get out of that process, to be able to have a dependable, reliable company like a Paychex or any other type of provider that's out there, but to be able to get that type of payment and cash inflow into your accounting firm within basically from start to finish, 27 days that they were implemented, and then a total payout within 183 days. What would that do for your firm? And don't just think about the money part. Think about the time part. Think about the responsibility that comes with maybe being part of that TPA, maybe being that tax preparer when it comes to payrolls. Imagine you didn't have to deal with that. And take a look at the numbers and the profit margins that what this produced. Imagine the difference that could make from your firm. And again, I don't treat any firm the same. Every single firm that I talk to operates on a completely different scale, different type of scale. I can never cookie cutter one firm, right? There may be firms out there that enjoy doing payroll, that maybe do have a more profitable service. And if you have that, that's great. Keep doing it, right? But ultimately, if you don't want that type of responsibility, if you'd like to take specific resources, whether it's people, whether it's money, whether it's technology, and be able to take that money or time or energy and focus it on somewhere else on larger profit margins, this is really where the vision is at. And again, when you're revaluing not just payroll or even any type of TPA, think about maybe you're into bookkeeping. Maybe there's another process within your firm that you can say, hey, you know what? Maybe this is something that we can outsource. This is something that you can really kind of think about in the long term, right? And this is actually the best time of year to think about it as we get into 2023 with tax restart starting in January. This is probably the highest year that we've done acquisitions as a company. And again, the best time to really take a look at this is in January. So if you do have a Paychex rep that you have met and you have a relationship with, ask them about, hey, I heard you guys acquired payroll business and HR business. Talk to me about what that could look like for my firm. And if you don't have a Paychex rep, certainly give me a buzz. I will certainly put you in touch with one of your local reps to make sure that they do reach out to you, especially if you want a mass tax guide. But more importantly, to be able to have that type of partner at your firm where you can have someone dependable like a Paychex that can really be that extension of your firm and also make sure that you're getting your clients taken care of with a pretty nice payday to come with it, right? So this is really our program for acquisition program for accountants. It's really one of the best when it comes to within the industry and similar to our counterparts, our big friends at ADP. We like to take pride in our acquisition process because we really do give you that type of white glove treatment. This is another example of one that I've personally done locally here on Long Island in New York. Similar, not as big of a firm, but really this was more of a firm that really was just doing taxes and payroll for their clients. There's about 77 clients that we were able to convert with a purchase payout of $120,000 that we were able to pay out within about 180 days, right? And that they basically had a payout of 130%. So again, if you have that similar type of firm and you have a similar type of client base, this is what it could potentially look like. Don't hold me to these numbers. I do not come up with these numbers. This goes back to my finance and risk team to determine all this. Again, this is just kind of an example of a snapshot of, again, if there is a SOAR process within your firm, number one, what the cash flow can do for your firm if you chose to outsource and have it acquired, but also number two, the peace of mind and the time that it can bring back and be able to shift those resources. And again, we have testimonials left and right. So again, don't take it from me. Take it from a lot of your peers that have gone through this process before and have an excellent experience, not just for themselves, but how thrilled their clients are. And so again, why does our process work? Nearly 20% of our client base has been with us for over 10 years. Transition away from lower profit margin activities. 4,200 clients converted through the process in the last 12 months, 98% retention of clients converted. And again, quick profit paid. And when you have a dedicated team from the service side and from the sales side, kind of like where my position is in, this is really where we really hold our process to a high esteem. And again, when you talk about who you're going to work with in general when it comes to an outsourced HCM provider, look for somebody that's proven, look for someone that's experienced, look for somebody that's principled, and that is obviously trusted. And again, if you ever do research on our company, you will see all the accolades that come with us. And again, when we have somebody like the AICPA that backs us up, we do the AICPA's payroll, retirement, and HR. And at the end of the day, when we have their backing to say, hey, we believe Paychex does a great job and you should be able to refer them confidently, again, that really goes a long way with our partnership with the AICPA and CPA.com. But we're not just payroll, right? Most of them, again, I talked about this at the beginning of our call here. Don't just box us into payroll. That's the easy part. We've been doing that for 50 years. It's our bread and butter. It's really how else are we helping your clients grow? Employee retention tax credit, very top of mind. You see all the advertisements, not just from Paychex, but you hear it on the radio, whether it's satellite radio, you hear it on TV. Tax credits, these are something that your clients need. And if there is some sort of eligibility, I encourage you, please explore it. And if you have been doing it, congratulations. And if you don't have a resource for the ERTC, feel free to give me a buzz. Our average client return based on client size is about 188,000 average refund back to their clients. And that really says something. What could your clients do with an average return of $188,000? Really says something there. PEO, one of the other things that's really growing top of mind right now as health insurance rates are increasing. They're not going down, let's put it that way. And be able to have a lot of your small to medium size and even your larger size clients be able to have that type of purchasing power through a PEO, where instead of being prorated as a 10 employee company or as a 50 or 100 employee company, be rated as a 15,000 employee company by getting involved with the PEO. Again, that's the bang for your buck right there. And you really look like a superhero by making a recommendation to at least, again, explore the other PEOs too, by all means. But when it comes to our process, we'd like to think that we're top class when it comes to our PEO solution. We offer time and attendance. We have a full service insurance agency. Our insurance agency is a top 25 agency within the country. Our retirement and pre-tax benefits. We are the largest record keeper for retirement plans across the country. We're doing 1 out of every 12 401k plans. We do not do any financial advising. So if that gives you any chills there, again, we do not do any financial advising. We just do third-party administration and compliance pieces when it comes to retirement and pre-tax benefits. And in fact, if you know a financial advisor that wants to be attached to a plan, again, give me a buzz. We can make sure that a financial advisor can be connected to that. And that's why financial advisors love us as well. We've recently, within the past 5 years, gone into payment processing and merchant services. Again, it's very much a commodity industry when you come to that, but when you have the ability to combine technology that Paychex has with the rate that we're able to offer, again, give us an invoice. Let us take a look at it. We'll do a good job with it. Hands-on human resources, that really kind of ties back into the PEO as well. We have over 600 HR professionals that when they are participating on our HR platform, they have access and ease of disposal to utilize our HR generalists at any given time to be able to assist with onboarding, hiring, training, proper paperwork, building a handbook. This is really, we're in a compliance time right now when it comes to your clients. You want to make sure that they're doing the right way and not cutting corners, and that the CFO is also wearing the HR hat. No, you need to have somebody that's professionally trained, that has SHRM certification, that is constantly getting updated on all the labor laws. And our ASO and HR platform certainly gives the client that option. We integrate with software. We have plenty of APIs to integrate with any type of data, hiring, onboarding, and training solutions. We are now going international as well. And then on top of that, if any of you guys have the Paychecks platform as utilizing our Accountant HQ platform, you've seen our user interface. You see how easy it is to pull our reports. And quite frankly, I think we do also have the best reports when it comes to looking at a lot of your clients' reports. And again, this is really just kind of some credentialing here for us. Again, I kind of talked about a few things on here. Again, I don't want to beat a hammer over the head here, but in terms of our credibility, again, we're nationwide. Again, just take a look at some of these stats. And again, strengthen your status as the most trusted business advisor, right? When you outsource client HR administration, payroll, that can lead to enhanced consultative opportunities and a more proactive approach to identifying client needs and challenges. Partnering with an industry expert, someone like a Paychex, can help create that freedom to engage with higher margin services that assist with your firm growth. So again, we've been around for over 50 years at this point. Again, I don't really want to go over the head too much for the credibility here, but if you do have any questions about PEO, if you do have any questions about any of the services I went over, if you do have any questions about, hey, who's my Paychex rep, can you put me in contact with them? Feel free to take a picture of my information here. I will certainly route you in the right direction, as well as give you a little bit more information on our acquisition process. And Peter, I hope I did not go too much over time here.
You're perfectly fine, Phil, and I really appreciate your insight. You hit upon a lot of really important points, including the HR solutions. When you think about many of the smaller firms and knowing how onerous and arduous the labor laws are with EOC compliance at the federal level, different state level regulations, really great to have a partner to be able to ensure, especially with remote work environments today. You know, before COVID, I'll call it the BC era, not before Christ, but before COVID, it was rare to have an employee work in a state where an accounting firm didn't have a physical office. Today, that's now commonplace. So it's creating a lot more compliance around that. So really,
yeah, multi-state. Peter, I'll say multi-state is the excellent fit for PEO because we're registered in all 50 states. You don't have to worry about getting all your, withholding IDs and your unemployment IDs, or if you're doing business in the state of Washington, good luck, because you need about 7 different IDs to do business over there. So we're registered in all those 50 states to be able to support that. So yeah, I hope this was useful information.
Simply outstanding. Thanks very kindly, Phil.
Thank
Can you
Peter.
make your slide deck available to the attendees? Is that a possibility?
Absolutely. How would you like me to do that?
You might be able to upload it, and I'll instant message you on the side. I want to introduce Yash and Amit from Infinity Globus, and I'm really impressed with their business model as, I'll call it, a global center of excellence for tax training and staffing augmentation services. And Yash, maybe you can talk a little bit about the Phoenix Institute and Infinity Globus and how you're training the next generation of accountants to work on advisory services and attest services, tax services, and how you're helping them bridge that theory successfully into practice.
Sure, Peter. Thank you for the introduction. So yeah, Phoenix Institute and Infinity Globus. Phoenix Institute is one of the US accounting and tax training institute, and Infinity Globus is the outsourcing provider to the CPA, EA, and accounting firm in the States. Now, we see that there is a very much staffing augmentation going around in the industry over the world, and there is always a crunch of the resources to get on board, to get the trained resources. We have developed a training institute, Phoenix Institute, where they are providing a practical training courses to the students and the industry providers. And with that practical training courses, what we consider and we take into the course material is that we just don't do it in a way just making them a theoretical approach for learning the US accounting tax advisory things of the courses, but we also include them within the practical sessions as well, where they will be not just putting up the standard forms or just doing the entry into the softwares, but they know how to prepare the work papers. They know how to tie out with the tax returns with the work papers. They know how to uh, make the notes for the financial statements. So sort of the accounting bookkeeping also, they know how to list out the open points. So they know in depth the training about how the US accounting firm works, and they had the practical approach of understanding and gathering the knowledge on how the CPA firm runs when they are just doing their training with the Phoenix Institute. And once they clear with the training, they are very trained resources. They can be easily get onboarded to the organizations in the states, in the firms, as well as in the India itself also. So also we observe that staffing and training goes hands to hands. It's not just that we get the qualified staff every time. So and as we grow ourselves, we didn't just come and started running. We started baby steps. We started with crawling, and then we started running. So it goes in the step to step. So even though within the staffing need as well, we don't get, or everybody doesn't get a trained staff. So training is obviously needed. So there is a refresher training that goes from the month of non-busy period, so May, June, December, November, where the team is free. There is we currently take the change in the law amendments to cover up in the training program. Now we know for 2022 that auto mileage has been two separate rate is there for auto mileage. Obviously, it was there only a single rate every year. Now, this is something that is more important to consider while you are looking on the compliances for your client. You are serving on the compliances for your client. So those steps are, or those things are little things, but there's are the crucial things where the team should be definitely get themselves acquainted to. The other area I can say is the ERC. So when the ERC gets rolled out, nobody knows about that. Nobody has the prior experience on the ERC. So we screen down the team members. We identify good analytical skills within the team. We crack down the ERC rules, getting the understanding on the qualification criteria, filing requirements, and with the providing little bit training to the team member, we were able to deliver the ERC as a service to our client. The other area I can see coming down the line few years is the ESG, environmental, social, and corporate governance, that is just been rolled out in the March by the SEC. So that is the another area where we see that it's going to be a huge things for they are going to be for the accounting firms in the coming years. So it's like we need to see evolve ourselves within the what's the currently going over in the market, what are the new things that is required to be trained to the team members. So staffing, training, it goes hands to hand. So that is where we Phoenix Institute and a qualified staff of Infinity Globus comes into the role for outsourcing service provider to the US CPA firms and DEA firms.
That's outstanding, Yash.
Yeah.
And you basically operate as a seamless extension of the accounting firms, correct? So when they have different business needs, whether they be on the
Yes.
advisory side, the attest side, the tax compliance side, the consulting side, you work seamlessly with
Yes.
particular offices. And I know you have offices throughout the United States as well, correct? In Texas and Florida, which is tremendous. Have boots on the ground here in the States as well.
Yep. Amit, you can add on if there is anything.
Yeah, and so talking on that part, like, and before I talk about that, like Alan stated about like amazing thing about our industry, it's recession proof. So when the whole world is talking about like recession and everything, we are working in an industry where it's sort of recession proof, where client needs to comply with all the filings and everything. And in a post-pandemic world, we have seen like the business needs has changed. The accounting firm is no exceptions, and with all like merger and acquisitions, ongoing retirement of baby boomer generation, and staff retention challenges, like Alan many times points out in his speech, like most essential assets of the firm going home every day, and as an employer you are not sure if that assets like will be back next day the same, right? So along with all these challenges at Infinity Globus, what in terms of the services that we provide is start with a basic bookkeeping and accounting. In addition, it's not just we stay at that level as Yash talk about. We provide high level services, which includes that ERTCs, particularly that we have a whole team which has like expertise on that. In addition, we do a lot of tax provisions, some of the on audit assignments, even we support the SEC compliant PCOB audits as well. On a few engagement, we assisted to a big four on assignment basis. So those of the tasks that we do in terms of capabilities. So it's not just a basic accounting or basic tax return preparations, but all the high level of services and the offices that you talk about in the US. Yeah, we do have our offices in the Dallas and Houston in the state of Texas, and obviously in Florida as well. So these are the things that we do a lot. And to touch upon a couple of points that yes talk about on training, the things that we do at Phoenix Institute, which is our affiliates, and the focus is on a skill set. When there is a huge gap between the demand and supply, what we try and do is to train these freshers, graduates, and bring them into this industry, which has huge potentials for growth. So we try and bridge the gap between demand and supply with the help of our Phoenix Institute. And most important aspect of this Phoenix Institute is like this course is designed and run by experts professionals who have actual experience of working in this industry over 15 years. So that helps to like design a course which is really helpful in real life. The trainee goes through like actual tax return preparation with a dummy data. So when they are on board, they are not just fresher graduates, but well-trained staff.
Outstanding. And the size firms you're working with, you mentioned a big four firm, and I know you've done some with the top 10 as well, and you're going to all size firms, top 100, 200, 300 size firms. I would encourage the attendees on the broadcast, if your accounting firms are struggling with staffing shortages, to certainly reach out to the team here at Infinity Globus and have a complimentary consultation with them. I'm very impressed with the Phoenix Institute, how they teach all their candidates. They're licensed CPAs, they're enrolled agents, they're chartered accountants. The founder, Vivek, is a former BDO partner, and I know him well, and I can't speak more highly of Infinity Globus. So what are your predictions for next year? I know your team has grown tremendously, over 300 plus people this year in 2022. Are you still projecting similar growth into 2023?
Absolutely, Peter. Even with this, all these challenges that I just talk about, everyone will be looking for this solution with this high like need of these experienced professionals, and when we have a lot of challenges to retain the existing staff, and at the same time the cost cutting is equally important. So if we if someone gets that who can provide that high quality service, which along with that scalability to accommodate the growth, um, then there is like nothing better than that. So at Infinity Globus, we see same amount of growth and potentials that we have seen post-COVID era. So the surge in demand for accountant will be there. Obviously, along with that, outsourcing trend will be continued in 2023. And I see a lot of accounting firm will be looking for their outsourcing partner where they can more rely upon, not just in terms of delivering work, but quality work consistently delivering with the scalability. And so I see a lot of opportunities and growth for both accounting industry as a whole and outsourcing as well.
Outstanding, outstanding. Really appreciate your insights, Amit and Yash. Thank you so very kindly.
Thank you so much.
Thank you, Peter.
We have our next panelist, David Diaz of Walker Reed Strategies. He's going to be discussing the Inflation Reduction Act of 2022 that just got passed this past August and its impact on a handful of different energy tax incentives that his firm are subject matter experts in connection to 179D and 45L. David, welcome.
Thank you, Peter. Appreciate you guys having us on, and very, very happy to be here. So thanks for the opportunity to share some of this information with everyone, and thanks everyone for taking some time this afternoon. I'm going to share my screen and get out of the way here. So let me see. All right, can you guys see that clearly without? All right.
Yes.
So a little bit about our firm. We're a specialty energy tax incentive provider. Extremely niche firm focused solely on Section 179D, which is a commercial building energy efficient tax deduction, and the Section 45L, which is the residential energy efficiency tax credit for residential homes. A little bit, we pretty much work almost exclusively with CPA firms and cost segregation groups, specialty tax firms, as the engineering arm, kind of behind the scenes, handling the energy efficiency studies for those firms. We do go direct to some clients, but it's mainly in the energy sector. But really, our bread and butter is being the support team and the staff in the background, helping out the CPAs who have enough expertise to essentially bring these opportunities to the clients, but haven't decided that they want to put together an entire department around doing 179D and 45L and all the energy incentives in-house, because either they don't have the workload or honestly, you guys have bigger fish to fry. As Amit and Yash just spoke, I mean, there's enough trouble in getting staffing to do your core business as it is. Why the thoughts of going out and starting a new department to service this growing trend in the industry is pretty burdensome of a task. So that's really the role our firm serves. We're that partner to the CPA firm and help you guys accomplish these incentives and be able to bring them to your client base. So just want to kind of get, there's been some big, huge changes around the 179D and the 45L here over the past couple of years. Specifically, more recently, as part of the Inflation Reduction Act, there was some major changes. I'm going to go through this slide very quickly, and Peter, I'll share these slides later so that everybody can have them. Especially this one. This one could take up my whole 15 minutes if I go through this one slide. But just a little bit of a quick brief update as to what 179D was in the past for those who aren't familiar with it, and kind of where it's going will be the path of my conversation with you today. So in the past, 179D kind of comes in the form of two different incentives. It's one incentive of the 179D is focused specifically for the private building owner or owner-occupied commercial building owner who has either built a new building or made significant energy improvements to that building. And it has allowed for additional accelerated depreciation of up to $1.80 per square foot. And more recently, with some inflation adjustment provisions that were in place, up to $1.88 per square foot. And then the other side of 179D is the government building owners have the ability to allocate that deduction to the designers of the energy efficient buildings. So, folks working, architects, engineers, contractors, who are designers and design the improvements that are being made, whether they be retrofit or new construction, have had the opportunity to take advantage of this incentive on these government projects by the way of having those opportunities allocated to them via an allocation letter. So it's very, very attractive from both perspectives. Honestly, it's been more attractive in that government space versus the private sector. The private sector is still taking advantage of it. More recently, it's been a little less with the QIP changes that happened a couple years ago. So it's been a little bit less used within the private sector, but still very, very strong in the government-owned building sector, where they're allocating the deductions to those designers. And then there's the 45L, which 45L is a residential homes tax credit. It's mainly around new construction. Major renovations can participate as well. But if you have new construction, 3 stories or less in multifamily or single family home builders, the 45L is a $2,000 per unit tax credit that they can take if those buildings meet certain energy efficiency criteria. So with all 3 of these incentives, whether it be the 179D on the commercial side or the 45L, when we look at it from the point of view of the residential piece, I mean, the way to qualify is very similar in all of them. I mean, they're different technically, but I'm not going to get into that today. But for the most part, you have a building that has to be analyzed against a baseline standard, whether it be ASHRAE on the commercial side or the IECC standards when we look at it on the government side. And you have to basically do an energy analysis that compares the building that was built to the baseline standard that the IRS has proposed us to use. And realistically, we've seen pretty good qualification over the past couple of years. With the 179D, I mean, most buildings, 90% or more are getting $1.80 a square foot. Since we're going against an ASHRAE 2007 baseline, that standard is pretty, I won't call it weak, but it's not a hard standard to meet. And then on the flip side of that, with the 45Ls, we've been seeing about 80% qualify of the new homes in the apartment buildings that we've been looking at. Assisted living facilities as well as another area that we've been looking at for those incentives as well. So that's where 179D and these energy and 45L, these energy tax incentives have been over the past, since 2006 when this first came out, and then 2008 when the bulletins came out that actually provided some guidance on how to do this stuff. This has been the standards and how this has been operating for the past couple years. Now, I get excited because I get to use my Game of Thrones slide here. So there's big changes coming to both these incentives here as part of the Inflation Reduction Act. So I'm talking about these a little bit. Let's first talk about the 179D changes. There's a couple key driving factors for the 179D. One of the main ones and one of the main points that I'll talk about is whether you get a higher deduction amount or a lower deduction amount with these new upcoming changes is going to be based on meeting these projects, meeting the prevailing wage. and apprenticeship requirements. That was actually just, the IRS just put out a notice explaining what those requirements look like and what the qualification to meet those requirements are. That came out this about a week and a half ago, 2 weeks ago, something like that. That pretty much says that you have to have a project needs to be built using the prevailing wage rates that are published by sam.gov. And on top of that, all the projects also have to have a 12.5% apprenticeship participation within the total hours of the projects that are being constructed. So if the project is being built using prevailing wage, the new changes to the 179D has set the bar that you can get this higher criteria here, where if you meet prevailing wage, you can get up to $5 per square foot in 179D tax deduction amount. So it starts with a 25% reduction. So if you hit the 25% reduction mark, you can get $250 per square foot. And then each additional percentage point of qualification and energy savings against the baseline standard will yield you an additional 10 cents a square foot until you hit the $5 per square foot of the at the max cap point for the deduction. So this is a huge jump. And really, when they bumped it down to that 25% standard and made it dynamic, it's a big shift in the way 179D has been used and can qualify. So it's a huge opportunity there. Now, obviously, with the opportunity comes the downside too, right? The projects do still have to meet that prevailing wage requirement, and that's going to make some of those projects pretty dynamic. And in some areas of the country and in the government space, it probably won't be a problem. In other areas of the country, they're not going to be being built with prevailing wage. So if you're not using prevailing wage, the starting point comes down here. It's a 50 cents per square foot, and then you get 2 cents per square foot until you hit $1. So they're kind of penalizing you based on the past incentives if you're not meeting prevailing wage. So bright side is, from a qualification perspective, the expectation is we're going to have ASHRAE 07 for quite some time coming up. It'll still be the baseline for at least next 3 or 4 years. So that'll be a very positive thing from a qualifying perspective. Let me check my time, make sure I'm not going too long. I still got some time. So some of the other major changes, and one thing I want to mention about prevailing wage before I jump off, I'm going to go back a slide. Something to keep in mind is, with this new prevailing wage notice that came out, any projects that got started and have been substantially in progress of construction, there's technical rules and definitions to that within the prevailing wage guidelines. But any project that gets started prior to January 30th, 2023, pretty much grandfathered in of not needing to meet the prevailing wage. So if you have a project that gets completed starting in 2023 with a place in service date of 2023 or later, but was started prior to January 30th, 2023, that project could still get the $5 a square foot without having to meet the prevailing wage guidelines. So that's a very important thing to keep in mind. It's going to create a big opportunity for those projects that are under construction and are underway that won't be completed or placed in service in the 2022 tax year. So that's a big opportunity if we can take advantage for it for some of your clients. A couple more things coming up with the 179D changes. One of the big ones is that now tax exempt building owners can allocate the deduction as well. Previously, that allocation was only able to be given and allocated by government building owners. Now they're including nonprofits, 501c3s, tribal governments. So that's a huge expansion. So that's a big opportunity for those. And it's going to be interesting to play out how the marketplace adapts to that and how these nonprofits look at the monetization value of these incentives as they're trying to negotiate deals of getting things built. So there's going to be a new qualification methodology based on measurement and verification. We're waiting on notices to come out to have a better understanding of how that'll affect the marketplace. But that's going to be another opportunity. We're hoping it includes some alternative technologies like solar and other technologies in place that aren't currently fall under the scope of ASHRAE 90.1, but do save energy. So we're hoping to see see those benefits come into place. So, and another opportunity is that now a 179D can be taken on a building every 3 years for private building owners. So if you go and do, let's say, a lighting project, and then 3 years later you go and you do a HVAC project, now you can take the 179D 2 times versus historically, once you hit the 180 a square foot on a building, that was the extent of how much 179D you could do. So I'll skip this slide. I'll just jump over to the 45Ls, and I'm running out of time here. But a couple things with the 45L. 45L is going to have some big shift as well. Unfortunately, with the 45L, it's really that one's a really tough one to talk about intelligently, or at least give you guys great advice on, simply because the revamp of the program is very large. So we have to really wait to see how the notices come out. But some of the key points here, this current version is $2,000 per unit. They're going to bump it up to $2,500 per unit if a home is meeting the criteria of Energy Star program. Now that's the part where we don't know, right? What is it going to be? The full Energy Star program? Is the IRS going to point to different sections of Energy Star, or some adaptation of that program, which is a very common thing with these energy incentives, where they pick and choose what pieces of the provisions are going to get looked at. And then the homes can qualify for $5,000 per unit if they meet the Zero Energy Homes Ready program as well. Again, need to wait to see what the notice looks like on those incentives to be able to intelligently speak about qualifications, or whether yay or nay they're going to meet the requirements or not, as we look at this opportunity. And keep in mind, single family home builders will not need to meet the prevailing wage requirement, but the multifamily home builders will. So the multifamily space will have to meet the prevailing wage to be able to achieve the higher credit amount of the $2,500 and $5,000 per unit. The Energy Star criteria will, if you're not meeting prevailing wage, it's gonna, on multifamily, you're gonna get a bump down to $500 to $1,000 per unit. Now, it is my understanding that there's some attractive financing options out there through HUD, which have prevailing wage requirements in place. So maybe a combination of doing that HUD financing together with these credits can make the 45L be a little bit of an attractive opportunity to go through the trouble of getting these Energy Star certifications in place as we go through. So that's the 45L changes coming up. But if anybody has any questions, I'll share these slides here moving forward. Pete, if you want, send me how to do that, and I'll upload them for you guys. And
Sure.
feel free to give me a call. I'm happy. I'm always happy to talk about this stuff with folks and get people up to speed. If you have any questions or comments, I'm happy to entertain them. And again, Pete, thanks so much for the opportunity of having us today.
Oh, you're most welcome, Dave, and really appreciate your insights. When you're thinking about commercial, residential real estate owners making improvements to their building envelopes, energy efficient LED, energy efficient windows, LED lighting, HVACs, trying to tax affect your costs through this very important incentive is critical. So, have discussions for all the accountants on the line with your clients and figure out, are they making renovations to their building envelopes, and figure out if they could potentially qualify. So David, thank you so much.
No problem. Pete, I'm gonna mention one more thing too. I know
Please do.
There's been a ton of activity out there in the marketplace, even coming at my staff, people trying to hire them and whatnot. So I mean, if you're an accounting firm that's out there and you're looking to bring this service in-house and start a 179D practice in-house, I highly recommend having a friendly conversation with me about it. Because there may be some great opportunities that we can work together on we've developed some programs for firms that are in that process of making that shift, where we can kind of hold their hand throughout the process and be a valued partner there, probably for more cost effective than they would expect it to be. So let's have a conversation if that's something that we're thinking about. So.
Absolutely. Great point. And you're going to see more and more of the top 100 firms bringing them in and bringing that, call it federal credits and incentive service line in-house. That's an excellent point. Excellent point. Thank you so much.
Thank you.
Absolutely. Our next panelist is Chris Osler, who is the founder of Veritax Advisors, a leading tax advisory boutique, and he's got an incredible presentation today on unlocking the black box, if you will, of cost segregation services. Chris, absolute honor and privilege. Thank you for joining us.
Thanks, Pete. Hopefully you, I was hoping you wouldn't overblow the presentation there, but hopefully it's incredible. Hopefully most of the folks here can gain a little bit of insight here. It's my first time, so can you let me know, are you seeing the blue and white screen here with the black box?
I am not just yet.
Or are you just seeing my mug?
I just see your face, my friend. I do
All
not
right, let
see
me
your
share my
slide
screen
deck
then.
yet.
I'll share my screen and we'll get going here. How about now?
Yes, we can see the black box of cost segregation.
Fantastic. Let's see if we can get rolling then. Yeah, this is just for a little bit of background. Pete and I've known each other for about a decade now. I started in the credit incentives business back in 2010. Been a CPA for 26 years, came up through the Deloitte, Nevada practice back in the mid-90s, and decided to specialize in this area back in 2010. So there is a lot of good information out there about cost segregation, but what I found is there's a number of things that are sort of taken for granted that don't really match up with my experience in dealing with the IRS and their specialty tax group out of Austin that handles cost segregation specifically. So I wanted to address the purchase price allocation and that division between land and building. I hear a lot of information out there that seems self-assured. And the truth is in my conversations with the service and with the new ATG that just hit in June of this year with a whole bunch of changes in it, I thought it might be a good idea to do a quick update and use some examples here. So give me the high sign when we're running out of time, please, Pete. Otherwise, I'm going to plow ahead, talk about some of this stuff. Anyway, I'll skip that. That's
Absolutely.
we'll talk about that part later. So in the cost segregation world, the audit technique guide is basically the holy Bible of cost seg. And it's important for us as specialty providers to understand and really devour this information, understand how it works and how it comes together in the marketplace. Specifically, since we're interfacing with the CPA and the tax preparer community all the time. And we've always, every time we do a study, we'll get to this part of the discussion. 90% of the jobs that my firm does are related to purchases, existing buildings. And in that case, we're always going to have that discussion about, okay, how much of that purchase price are we going to allocate to the land? Well, the new ATG has a little bit to say about that. And I think we would be well served to run through that. I'm going to skip that one. We'll go to this particular slide here. As I mentioned, this is very common. The purchase price allocation, again, 9 out of 10 studies probably or more come through this vein. And it's very interesting. The new audit technique guide that just dropped starts on page 449. It starts to talk about the real estate allocations. And I wanted to highlight a couple things here. In practice, tax preparers typically determine the value of a land and building split by running to the county tax records. And that's usually what I've been hearing. I've heard that for the better part of the last dozen years, is that if we just use that split between land and building that the county tax records provide, then I think we're safe, we're good to go. Well, the truth is if you read through the ATG, you will see that the IRS's preferred valuation method for land is a land-specific appraisal. Now, I've seen a lot of appraisals in my career, and I would say probably 99 out of 100 don't specifically designate a value for the land in a real estate transaction. It may be a little bit more than that, but it's very infrequent where we're going to see an actual land valuation on a real estate appraisal that's done for a building. Now, I have seen some land-only appraisals, and based on this new ATG, the truth is that's what the service says, that's the highest form of evidence to show what the value of the underlying land is where these land improvements are sitting on. So absent a land appraisal, where do we turn as a profession? Well, we will typically turn to county tax records. And I put this quote in here specifically for everyone to see, so they can see what the service's opinion is about that and how they tell their auditors to react. I can just read here this quote. The value of total real estate less the value of the land result in the value of the improvements. Accordingly, it is inappropriate to estimate the value of land by subtracting the estimated value of the improvements from a lump sum real estate price. Basis assigned to land in this residual fashion may result in understating the appropriate basis in the land and overstating the appropriate basis of depreciable improvements. Now I get to the highlighted part in light blue. Examiners should also be wary if a cost segregation study relies solely on local assessed values rather than determining appropriately the fair market value. You see, in practice, these county tax records and the laws that give rise to these county tax assessments may or may not bear any resemblance to reality when it comes to the actual market values reflected in a real estate transaction. So the idea that as a tax preparing community that we can run to these assessed county assessor values and county assessor percentages and rely on them exclusively to determine the land and building split for tax purposes is just not true. It's not true anymore. It may be true that that valuation makes sense from a market standpoint, but that's not always the case. So given the fact that the service has said you don't want to solely rely on those records, what are we supposed to do as professionals in this space? Well, I don't mean this to be self-serving because there's lots of cost segregation service providers out there who provide a fully engineered study. My firm does. I can name a number of competitors who do the same thing. But the fully engineered study is one way that will allow you to follow the IRS's guidelines for their auditors that allows you to come up with the correct value for land given the lack of a land appraisal in the situation. So what they lay out in the ATG and what we follow in our profession, and I know a number of my competitors do the same thing that I do, because it's not rocket science to grab the audit technique guide and to reverse engineer your processes based on what the service is expecting to see if you're ever selected for audit. So we follow this replacement cost new less depreciation methodology. And this methodology uses replacement cost information from existing national data providers on construction information. In this case, Marshall and Swift and RS Means. We use RS Means in our firm, and this allows us to attach values to the items that are the improvements on any particular piece of land. And so what we do is the engineering side of this is when we recreate these land improvements from scratch using this replacement cost new methodology. There's a number of ways this is done in the marketplace. There are firms that use Excel spreadsheets. There are firms that use construction estimating software. My firm uses cost segregation specific software that's out in the marketplace now. But at the end of the day, the provider needs to create a new model that shows what it would cost to replace those assets and those improvements in today's dollars. And then the next piece of the calculation comes in. Well, we have to evaluate those improvements to see how much wear and tear is on them, see what their potentially what the remaining economic useful life is. And that is what we come up with this less depreciation piece. So the abbreviation is RCNLD, replacement cost new, less depreciation. And this is the methodology that most firms are using to approach the purchase price allocation when it comes to purchasing of an existing building. So let's take a peek real quick at what this ATG has to say about this. There are a number of bullet points that they tell their examiners to focus on. So we need to review acquisition documents. Obviously, we're going to be looking at things like escrow statements, appraisals, those types of things to tie back to what the amount was paid for that particular property. We need to ensure, again, this third bullet point here, that the land has been properly valued. And again, the service wants to see its highest possible assurance comes from a land-only appraisal. And that appraisal needs to determine the value of the land in its highest and best use. So again, those are almost non-existent when it comes to our clients purchasing a property and getting an appraisal for financing, that type of thing. They simply don't opine on the value of the land in most cases. So as we go through these requirements from the service, these older properties, they have to be adjusted for depreciation. And again, I'm just walking through the bullet points that are in the audit technique guide, circa page 50, where it starts to talk about this methodology that is the methodology that the service finds most representative of the engineering approach. So we come up with our replacement cost new, and we apply the economic conditions on the ground and other items to determine how much we need to discount from that replacement cost new to reflect the actual existing value of those improvements. So those adjustments have to be incorporated after the replacement cost new model is produced in order to get to the actual replacement cost new less depreciation. So it becomes very simple in that case. Once those things are calculated, you've got a sales price of the property, you've got replacement cost new less depreciation when the fully engineered cost seg study is performed. What ends up happening is A minus B equals land value. And I know that some of you out there probably haven't heard this before, may even want to argue about the merits of it, but I can tell you this much. One of our 2018 studies was subjected to audit, and it was a very thorough audit, the type of audit that I had never been subject to before in the cost segregation space. They actually went into the detailed engineering analysis and selected items for review and asked us to produce the underlying RS means data that supported those individual item costs. So it was a very thorough review. And I was told in no uncertain terms that the point of focus for the service is the land building allocation and the over allocation of a purchase price to the building, hence the focus in the new ATG. So when there is no independent land valuation available, I know that many of us will go to those county tax records, but what happens when that county tax record doesn't reflect reality or the economic reality on the ground? I'll give you an example of how that might work out. So this is a spreadsheet that lays out the replacement cost new. On the left-hand side, we apply the discount factor. And I think this is pretty much an unreadable slide from everybody's standpoint, so I'm just going to skip it. This was a recent single-family.
It's legible, actually, Chris. Just so you're aware, it was legible. Yeah.
Okay. Well, I think it's a lot of detail given the time constraints we have, Pete. So I'm gonna skip through it and talk specifically about this particular home. I go back to it. I think if it's necessary. So the gross cost that we come up with is here on the left-hand side. You can see these columns here, and they come up with a total, when you add up your 5-year, your 7, your 15, your 39, there's a total gross cost. That's the replacement cost new piece, right? This is how much it would cost to replace those improvements using the RS means information in today's dollars. Then the vertical blue column in the center is the discount we'll apply to come up with the replacement cost new less depreciation. This particular home is relatively new, so the discount factor, we only discounted it 10% in this case. You can see here that we multiply these gross cost items by 0.9 to come up with replacement cost new less depreciation. So this total at the bottom, the 387 and change, is actually then placed here at the top as the building depreciable value. So we take the purchase price, the 475, we subtract replacement cost new less depreciation, and the land value simply falls out the bottom. So in this case, this was a property that was in a real estate market that's not highly appreciated. So again, this is a snapshot of the gross cost side. It shows how all the items are calculated and which classes they're in. Again, these are derived from that engineering process that takes place. And this part here represents replacement cost new. So then we apply the discount, as I mentioned here, 10% in this case, going from 430,000 to 387. The result is then a building basis of 387,175.31. And again, based on my discussions with the service and their approach to how this works, for the building's purchase price, not accounting for any of the title charges or any of those other minor items that we will include. Purchase price minus replacement cost new less depreciation equals the land value. So in this case, the resulting RCNLD calculation leaves 87,000 in non-depreciable land. It's just roughly 18.5% of the purchase price. And again, I picked this one on purpose because it kind of works out perfectly. And in many cases, it's not this clean. So you may be saying, wait a minute, the ATG says it's inappropriate to estimate the value of the land by subtracting estimated improvements. Well, in this case, we're not estimating, we're using actual replacement cost numbers, relying on that national database of construction values to support the conclusions that we come up with. So the only way to get to this point is using the fully engineered study to build that building, to build those improvements up from scratch, applying all of the quantities and costs and getting to your gross cost number. So as I mentioned, this example works out perfectly. Everything looks good, but what happens when we have a highly appreciated real estate market? Let's take a look. This is an actual client building. This is a 1,400 square foot home that was purchased in San Bruno, California. It's overlooking the San Francisco Bay. And this investor paid $1.95 million for this 1,400 square foot lovely place on 1/5 of an acre. All right, so the house we just did, that had a replacement cost, gross cost in the low 400,000s, roughly the same size as this particular house. So what happens? We run to the county tax records, of course. In this case, the county says that the improvements value on this parcel is $89,000. The land value is $23,000. The total value $112,000. Again, local laws are what drive these values and the methodology behind determining the land versus improvements. So knowing that there's over 3,000 counties in the US, and they all might have a different idea about how to do these assessments at a local level, as a profession, as a group, the idea that we can simply rely on these and close our eyes to the economic reality underneath them makes no sense, and further evaluation is definitely required. So in this case, if you were inclined to go to the county records, you would say that the improvements percentage is 79%. So in theory, using what I was talking about before about the IRS's formula, purchase price minus replacement cost new less depreciation equals land value, we're not going to get there. using an engineering method. And I'll show you this in here in just a second. So this is the gross cost side for this house. And as I said, it's 1,400 square feet. We came up with about $400,000 of gross cost. So with the replacement cost new, it's only $401,000 on a 1,400 square foot home. That makes sense. It's roughly the same as the other 1,400 square foot home that was somewhere in Florida. So even if this home were new, it's not, it's roughly 60 years old. And we could use the full replacement cost, which we can't, but if we could, we're still only coming up with $400,000 of cost. Why would an investor pay $2 million for a place that only costs $400,000 to reconstitute? It's pretty simple. And the IRS essentially told me the same thing. A minus B equals land value. So this is where we come into a little bit of an issue. So we got $400,000 in gross cost. Our client paid $2 million. So what do they want to do? They want to use the county tax records and take 79% of that $2 million as depreciable land improvements. Well, our replacement cost new, see this less depreciation, a 10% depreciation factor on this particular house may seem unreasonable, but it had been recently renovated and it's in very good shape. That being said, our replacement cost new number, this should be our theoretical tax base is $361,000 depreciable. The rest, 1.6 plus, would go into land if we were following what the service has to say. Well, this investor didn't want to do that. He wanted to use the numbers from the county. So instead, they're going to depreciate $1.54 million on a building that would cost $400,000 to replace new. So what we have to do here is we have to increase the replacement cost new minus less depreciation number by over 400% to get to this $1.5 million. So we've stretched that taffy so far that it's just about to tear. And again, I only bring this up because this is a point of focus from the service that I got right out of the horse's mouth. So does it make sense to use the county tax record in this situation? I'll let you think about that for a second. If you think it does, then I'll ask you the same question that I asked this investor. I said, Mr. Investor, you paid $2 million for this house. It's 1,400 square feet. It's on 1/5 of an acre. Would you pay $2 million for this house if I could magically transport it to Fargo, North Dakota? And of course, the investor's going to laugh because there's no way in the world that they'd pay $2 million for this house and that size of a lot in Fargo, North Dakota. And I asked him why. What's the difference? The difference is the value of the location, of course. We all know this. The IRS knows this. We know this. Thinking now with the new audit technique guide that tells the auditor, don't just rely on those local assessed values, thinking that we as a professionals can hide behind those local assessed values in the face of evidence to the contrary doesn't make sense anymore. So what we need to do is become more realistic about how we approach the land building allocation. And again, the fully engineered cost segregation study is a great method to come up with that number. The funny part about this is the client hires me to do the cost segregation study. I do the study and I prove that his depreciable basis that he's electing to put on his tax return is 400% too high. I'm proving it using the preferred IRS methodology of performing a cost segregation study. I'm proving that their number is 4 times too high. And this is the support they have for their tax position. This 400% stretch right here, this tax basis factor, that's going to get them in trouble if they go under examination, and they'll probably face an adjustment. So this is what I'm trying to advocate and evangelize in the cost segregation space with my fellow CPAs. Is we can't just hide behind that property tax record anymore. We have to step outside that world, and we have to look at what's really happening on the ground. If you know your clients bought a property in California, in Washington, Oregon, anywhere on the upper East Coast, you know that that evaluation may or may not reflect economic reality on the ground. And if that is the case, then you may need to make another decision with regard to what that land building split is going to be. That's all I've got. Pete, how are we doing on time?
Doing perfect. Really appreciate your insights. Maybe, Chris, you want to remind the attendees about 100% bonus depreciation this year that runs out at the end of the year, where the rules reset next year.
Yeah, there's a lot of panic going on out there right now. Actually, it's driving a lot of business because of misinformation, honestly. A lot of folks think that, one, that 100% bonus depreciation on the 5 and 7 and 15-year assets that we find is going away. It is not going away. It's simply stepping down 20% in the coming tax year. So for the tax year 2023, our bonus depreciation percentage is going to 80%. The other thing that seems to be a source of a lot of misinformation is that they have to finish their study before the end of the year. That is not true. You can buy a house the end of 2022, and we can do the study as late as September, as long as you're on extension. You don't have to have the study done by the end of the year. But yes, Pete, you're correct. Under existing law, those additional first-year depreciation amounts are going to start stepping down 20% per year, starting on January 1st. So all of 2023 will be working with 80% bonus. The rest of it, the other 20%, is going to just spread out normally over 5 or 15 or 7-year class life. 2024 will find a 60% bonus. And again, historically speaking, these bonus numbers are amazing. Before the TCJA hit in late September of 2017, there was no bonus depreciation on existing real estate inventory. You had to build something new from scratch to get a 50% bonus on the 5 or 15-year property we could find through the study. But that was really the key thing that happened in the TCJA. They made used property eligible for bonus. So yes, we're stepping down to 80% next year, 60% in 2024, and so on until it completely phases out, assuming Congress doesn't act and change the law.
Outstanding.
Any questions out there, Pete?
There's nothing in the chat box,
Okay.
but I would want to remind the attendees also, if they have a client, I see this on my client base where they're contemplating a purchase. It's not just the close of it. They have to place it into service as well. Sometimes they'll leave it on the sidelines because they're demoing it and there's going to be changes to the floor configuration layout. But the best thing to do would be place it into service by the end of this calendar year to get the bonus. And like you said, at the end of the day, it's not the end of the world. If you got 80% next year, it's still a substantial benefit. There's no question.
Right. And I feel bad for some of these clients. They're trying to rush through the door here and get something purchased by the end of the year. And everybody I talk to say, listen, buying it by the end of the year is one thing. Having it legitimately in service before the end of the year, that's another discussion. And that's something you'll need to speak with your tax preparer about to see if you're both comfortable taking that position. If you don't have a renter in place and you're buying residential rental property, is it in service until you get somebody in there? Good question. It just depends on a number of factors. So it is a bit of a high pressure time right now, a little high stress time coming into the end of 100% bonus and the end of the calendar year, and the end of tax year. Lots of questions flying around out there. So
sure. And with rising interest rates, right? That's another thing that complicates it.
Yeah, and not entirely sure how that's going to affect the business going forward as far as new purchases into 2023 because of the higher financing costs that are there. But of course, we've got look back studies we can do. We've got essentially a 5-year time frame of 100% bonus depreciation on everything purchased between September 27th, 2017 until the end of this year. So again, this is a point I need to make with customers, not necessarily with this group of folks on this call, but our customers who don't know, they think they need to buy now so they can or get their study done before the end of the year so they don't miss out on 100% bonus. I said, well, when did you purchase your property? They said, well, I purchased it in April of this year. Well, yeah. Okay, well, did you have a renter in place in April? Yeah, we got it immediately rented. I said, that's okay. You don't need to do the study before the end of the year. You just need to do it before you file. So again, a lot of misinformation and uncertainty out there about all the moving parts, but we're here to help you clear it up. If you have any questions, got my number and my email address here. I take a lot of calls and do a lot of meetings to help folks understand the parameters behind what we're doing and what the benefits might be.
Outstanding, Chris, outstanding. Can you make your slide deck available for the attendees?
You bet. I've got this already as a PDF, so I can just get it sent off to you, Pete, or to whomever. I'll put it in the.
Yeah, send it to me. That'd be fine. And I'll get it to the membership. Greatly
Sounds good.
appreciate all of the insights from our esteemed panelists on today's Washington National Tax Roundtable Year in Review Summit. I want to thank the attendees. I hope everyone found it insightful and interactive, and we'll look forward to seeing everyone in the new year. Have a happy holidays, everyone.
Thanks, Pete.
Thank you.
Thank you,
Take care,
Peter.
everyone.
Thank you.
Thanks.